Happy New Year, everyone, and welcome to the first video of 2024. And where better to start than with the world's largest economy, the US, and the central bank, the Federal Reserve. Now, on Wednesday, we heard from the Fed, or at least we got the minutes from the December meeting. And to be honest, I don't think there was too much to take away from the minutes themselves. They were somewhat outdated, as they always are. We've heard from plenty of policymakers since. But also, you could see from the minutes themselves that they were trying to paint a bit more of a hawkish message. It was hard to get away from the dovishness of the announcement itself back in December because of the dot plot. It's something that other central banks don't commit to, but the Federal Reserve does. So no matter what the language it used was, the fact that the mean projection for interest rates next year from policymakers at the Fed was for the rate to be 75 basis points lower than it currently is, told us everything we needed to know. So even if the minutes did suggest that we could still potentially see rates rise from here and that it will be some time before we start to see them fall, it's quite difficult to take that more than with a pinch of salt. And the reason for that is if they do see the Fed funds rate 75 basis points below, it either needs to rise immediately and then start falling immediately thereafter, or we're going to see a lot of those rate cuts backdated towards the back end of the year around the US presidential election, which seems, again, hard to fathom. So I think the message that the markets have still taken is that the Fed currently believes they're going to start to cut rates maybe around the second quarter, maybe around June time, and then potentially one per quarter thereafter. That's the current view, we should say, that is susceptible to change, as we've seen over the course of the last few months. So markets are positioned more aggressively than that. You can see here markets are still pricing in 150 basis points of rate cuts, so twice as much as the Federal Reserve starting in March. And the next meeting will give us more insight into how realistic that is. The Fed is going to have to start laying the groundwork for a March rate cut at the next meeting if it is going to seriously consider that. And the data that we see over the coming days and weeks will determine whether that is ultimately going to be the case. The next big release that we get from the US is the US jobs report. Now that is due on Friday, and we should see from that whether we're seeing further heat come out of the labour market. As we saw from the JOLTS data yesterday, it was quite clear that we are seeing some heat coming out of the jobs market, but job openings are still higher than they were previously, and in much the same way with the jobs report now, while we are seeing lower employment growth and we are expecting to see unemployment creep slightly higher, we are talking about moderate improvements or moderate deterioration in the labour market improvement if you're looking at it from a Fed's perspective in terms of looking for a labour market that is not overly hot, that is creating inflationary pressures. But ultimately, I think the most important takeaway from the jobs report tomorrow is going to be the wages number. Now, we saw wages rise by 0.4% last month, and that's expected to be more like 0.3% this month. If we can see a downward revision to the November number, or even a beat on the December number, then that could potentially be another thing that gives investors confidence that we are going to get that first interest rate cut in March. Now, let's take a look at what impact that all has on the euro-dollar chart. And as you can see, the euro-dollar pair has started to trend lower over the course of the last 5 sessions or so. This may be a little bit of profit taking going into the end of 2023 and going into 2024. It is worth noting that it had been on a very strong run over the course of the last 2 months since those lows in early October. And the jobs report Friday could determine whether that turns into a deeper correction or we see it continue to rotate higher, something we've already started to see ahead of the release. You can see around that 61.8 Fibonacci retracement level there, just around 109 is where we've started to rotate slightly higher. Ultimately, I think the jobs report could have a big say in whether we continue to rotate higher from here or break below. If we do see a break below, then I'd be inclined to stretch out this Fibonacci level back towards the previous lows that we saw at October. So the entire trend low to the entire trend high, to look for potential areas of support if the price is going to rotate lower from that area, which is entirely plausible because this has been quite a strong and prolonged trend from those October lows. But at this point in time, I'm going to keep my fib low around that most recent low, so December lows to December highs, and see if this is looking like a potential rotation point. One reason why people may start to get a little bit nervous around where the highs are is because of where the pair has traded throughout 2023. Now, let me stretch this out here just to highlight that. In 2023, you could see that the pair Every time we came around those 110 levels, we did see it eventually move lower. Sometimes it was quicker than others. You can see here, for example, that we rotated very quickly lower. It was less than 24 hours before the pair did trend lower. Throughout the summer, we actually tested a little bit more significantly, and we did briefly break above it on occasions, but ultimately, again, it rotated back lower. Now here, late in the summer, you saw it broke significantly higher before rotating lower, but that lasted maybe 2 or 3 weeks, and then next thing we're back towards that 105, 110 zone, and actually moving back towards the lower bound of that trading range. So you could see that this is a range that's been very well established over the course of the last 12 months, and it may be one of the reasons why traders may start to get nervous in around what was 10 levels, because already we've broken higher and then we've rotated back inside. So a stronger jobs report tomorrow could reinforce those fears and potentially see a break of that 109, 108.82, 61.8 fib, at which point I'd be inclined to stretch out that Fibonacci retracement zone. So it's going to be a really interesting one to watch now over the coming days and weeks and months even, because one of the things which is clear right now is that markets are heavily pricing in 150 basis points of rate cuts, not just for the Federal Reserve, but for the ECB as well. So they're relatively well aligned. If we start to see any disparity between the two, e.g., markets pricing in fewer rate hikes, fewer rate cuts for the Federal Reserve, as an example, then that could be something that draws this currency pair back in further into this trading range and leave it range bound between that 105 and 110 zone. If we see weaker data tomorrow and the markets maybe pricing a 7th rate cut or 175 basis points in total, then that could be something that potentially propels this back towards those previous highs and out of the zone that it's traded in for such a long time.